no longer count the years that passed without the American recession that had been widely predicted by analysts and investors. 2025 was one such year and, in our opinion, 2026 will be another. As a matter of fact, when faced with demand that remains stable, the data show that American business owners have rebalanced the composition of factors of production in favor of AI investments, without any alarming increase in unemployment. In this sense, we believe that the US is experiencing a production revolution befitting Tomasi di Lampedusa's The Leopard, aiming to meet strong consumption demand, but with a different mix of production factors. The same revolutionary principle could apply to the Eurozone and China, with one substantial difference. A precondition for the two economies to start recovering and avoid recession, as per our baseline scenario, is for Germany to implement its approved ambitious fiscal plan and for China to continue launching reforms and stimuli to support domestic demand. Our macro outlook remains consistent with an inflation trend that is on track for its target in both the US and the Eurozone, whereas we expect price dynamics in China to continue moving well below the objective of the central bank. This should be enough to support the Fed and the ECB on their path to easing financial conditions for disinflationary reasons, although more evident in the US considering the political pressure set to grow with the upcoming midterm elections. The Chinese central bank will also play a role in cutting rates, but the keystone for escaping this inflationary trap remains the considerable development of fiscal stimuli or the adoption of unconventional monetary policy. The latter, we believe, is unlikely in 2026. We are moderately optimistic about the bond markets in 2026. We expect that the performance of government securities will be supported by historically high returns, while space for a drop in the rates is limited across all geographies. In the US, in particular, solid growth and an excessively accommodative Fed constitute factors that could negatively impact high-duration positions. In the Eurozone, the possible acceleration of quarterly growth and increase in the supply of government securities in Germany could push bonds returns to higher levels than those we are currently seeing, while BTP's performance will be almost in line with that of bonds. In 2026, the outlook for global equity markets remains positive. We expect that the main benchmarks will hit new highs. At the sector level, we still prefer cyclicals over defensive, with the most constructive view on growth securities. From a regional perspective, we prefer the US over the remaining DM markets amid the preeminence of the AI sector, but we believe that Europe and Japan will also see a positive performance with support from local fiscal stimulus plans. Lastly, we maintain an optimistic view on the emerging markets by virtue of supporting a rising from a combination of structural and cyclical factors. Though it may seem paradoxical, we think that the most important macro risk is an overheating of the American economy. This scenario could prove positive for equity markets, at least in the short term, but penalizing for bonds. The situation could worsen if tariffs were to be abolished and not restored quickly, and/or the Trump administration decided to approve expansion of fiscal measures such as the recently aired tariff checks. Another macro risk that would mainly affect the equity market is represented by a faster and more pervasive integration of AI into the production system that had been incorporated into our scenario. Lastly, where geopolitical risks are concerned, we are monitoring relations between China and the US, developments in the Middle East and the fragile equilibrium in France.